Well, welcome to 3X Your Real Estate Returns without taking any more risk. My name is Eric Martineau. My wife is Diane. Diane asked me if I would present this video. In fact, Diane and I met in Quantico, Virginia. In fact, I bought my first threeplex just a couple of weeks after I got out of officer candidate school. And I met Diane about a month later. We got married. We were both Marines, about 11 or 12 years between each of us. And so we decided, in fact, our first date was, I believe, I invited her over to the house I had just bought, the threeplex I had just bought, and I suckered her into painting some of the walls. Anyhow, so much for being a romantic, huh? Diane and I ended up buying real estate every time the Marine Corps moved us. We went to Camp Pendleton. We bought a number of properties. Then I got sent up to Oregon State as the Marine officer instructor. We bought a roller rink and some more properties up there. Then we came out to Utah, then back to Los Angeles. Anyhow, we had decided that this is how we were going to retire, so that when we were old and gray, we could just live off of our real estate. And we had about 16 properties, had being the key word there, because we lost it all in 2008. Now, I am a proponent of lifelong education. I started a third master's degree when I was 53. Diane, by the way, passed the LSAT about a month ago and just got accepted into law school. So I think she'll be over 60 when she finally graduates. So we believe education is a lifelong thing. So I want to applaud you for being here to learn. Obviously, many of the most important things we learn in life do not happen in a classroom. They happen through hard knocks. And we lost all those properties you can see on that screen right there in 2008. We made some mistakes and we learned. And so I kind of want to help you to learn from what we did wrong, because they obviously didn't teach me this stuff during my MBA. Now, we all have to start someplace. And the reason I just told you that backstory is because Diane and I had to start over just before we were ready to retire. We thought we had done everything right. We had all those properties, we had all the income coming in, and we thought that we were just going to be able to retire and everything would be smooth sailing. You know, we look at successful people sometime and we see, like on the iceberg there, you know, you got a picture of this iceberg and you only see the top and you don't see all the struggle that went on behind. As I just said, Diane and I had to start over, and you don't always see that. You know, I guess I think about, I just saw a list of some of the richest men in the world, and what's that guy's name? Elon Musk was on there. You know, a lot of things, well, he's a billionaire. Yeah, but nobody seems to remember back when he was programming PayPal and sleeping in the back of his car. He was so poor and destitute. So we don't always see where people have come from to get to the success, but you just got to start somewhere. Like, you know, like Nike says, just do it. Start somewhere, and even if you failed, like Diane and I did back in 2008 and lost everything, have the courage to start again. And hopefully some of the things that we're going to show you here will help you. Like I said, it's... I did not learn in school the things that I want to talk about today. In fact, I learned them from Robert Kiyosaki, a lot of it. In fact, Robert Kiyosaki teamed up with Stephen Covey, the gentleman that wrote the book about 7 Habits of Highly Successful People. And I was trained as one of their life coaches, and I did that for a number of years. But sticking with Robert Kiyosaki, you know, most people have already read Rich Dad Poor Dad, or at least they've heard about it. One of my favorites of all his books, and he's got many of them, is called The Cash Flow Quadrant. I think I learned more there than in Rich Dad Poor Dad, because he kind of spells it out, where he explains how we can go from being an employee, where we just trade time for money, to being self-employed, where our time is usually worth a little bit more, but we still don't have any leverage. And then the next step in the process is to go to being a business owner, where other people depend on us and we depend on them, and we own a business. And then the last one is to be an investor. And I'm not going to go into each of those, but if you've never read The Cash Flow Quadrant, I highly recommend that book. But one of the things that I want to touch on that Robert Kiyosaki did for me is he defined some things that were not defined in the same way they were during my MBA. In my MBA, you're taught, you know, the financial side of things and what an asset is and what a liability is. Robert Kiyosaki redefined some of that. He said, invest in assets. But then he gave a really simple definition for what an asset is. He said, assets put money in your pocket. Period. Assets put money in your pocket. In other words, a lot of people think that their home is an asset. And sure, a lot of us have equity in our home. But by his definition, if it isn't putting money in your pocket every month, it isn't an asset. And so for most of us, the home we live in is not an asset because we're paying money to get it. Sure, it might be appreciating, and that equity is an asset, obviously. But if it's not something that is actively putting money in your pocket, it isn't an asset. And that changed my mindset. See, because I had bought most of the homes that Diane and I purchased with negative cash flows. We had felt that we could put them on 15-year mortgages, and we'd be, when we got out of the Marine Corps at about age 45, we'd have all this property and everything would be good. Well, life came along and it didn't work out that way, and because most of the properties we owned were underwater after I got out of the Marine Corps, before I could retire from the Marine Corps, I got out, and when I got laid off, and Diane was a full-time mom at the time, we didn't have any income, and that's why we lost everything, is because we didn't have the cash flow that we needed. So cash flow becomes very important. Okay? So for me, an asset means positive cash flow. Real simple. What I'm going to show you tonight are some techniques that I believe, whether you're a seasoned real estate investor or you're brand new in this, you're going to learn something. Now, if you are seasoned, I apologize. I'm going to kind of ramp it up and give some basics in the beginning, but I guarantee you there's going to be some stuff at the end of this that even if you are a seasoned real estate investor, you probably have never heard of or thought through. So bear with me if you're seasoned. If not, hang on, take some notes, and it'll be good over you anyhow. What I want to do is compare a cash purchase of a property with leverage or other people's money. And this is kind of the Robert Kiyosaki thing, right? Where you use other people's money. So let's assume that somebody has saved up $150,000 and they go out and they pay cash for a home. The rent on that home is $1,200 a month or $14,000 a year. Okay? Now, one of the terms that I want to explain tonight is called cash on cash rate of return. Okay, so what you do is you divide the 14,000 by the 150, and that comes up with 9.6. So in this scenario, we've got a 9.6 rate of return, cash on cash. Now this is gross. Obviously, I'm sure somebody's already out there going, wait a minute, man, just because you bring in $1,200 in rent doesn't mean that that's, all. There's other expenses. Yes, there are, and we'll cover those in a minute. Just bear with me for now. I'm just giving the rent and just dividing it as such. That is a gross, not a net, cash on cash rate of return. We will get to net for those of you that are already catching that. 150. Purchase with other people's money. Now, let's say that you put 20% down, which would be $30,000. That means that your mortgage is now $120,000, right? And your down payment is $30,000. You still have the same rent, $1,200 or $14,000 a year. So what I did is I went and used this mortgage calculator to decide, how much I'd need to pay. So we've got a $120,000 loan, 6% annual percentage rate. Now I know interest rates are at historic lows. We just refinanced at 2.65, right? But I'm going to use numbers that have been around my world for 30, 40 years of investing in real estate tonight. And besides, it is an investment property, and those are a little bit higher usually. So bear with me, even though I'm using 6% and the market today is below 3 or whatever. But I think this is more realistic of what it's been for the last 40 years, and who knows, it may go back there. So that's why I chose 6%. So bear with me on that. And then 36 months or 30 years, right? And what that did is it gave us then a payment of $720 a month about. Okay, so that's where I'm going to use that number. So back to our example here, now we don't get to pocket that whole $1,200 a month, obviously, because we have a mortgage payment of $720. So all we get to pocket is, again, the asset is providing us money in our pocket of $480 a month, or $5,760 a year. Again, I know that there's maintenance, I know that there's taxes, and I know that there's mortgage payments. I mean, not mortgage payments, but insurance on top of all this. But I'm doing the same on both sides just to give us the number, okay? I will go to a net in just a second. So if we've got $1,400 a year, $14,000, sorry. Okay, so if we have $14,000 a year divided by $150,000, that gives us again the 9.6 cash on cash rate of return. But in the other scenario, all we had to do is put in $30,000, right? The 20% down. And we get a cash flow of $480 a month and $5,760 a year. Now, if we divide the $5,760 by the $30,000, that gives us a cash on cash rate of return of 19.2. So we've doubled our cash on cash rate of return by leveraging it. Now I know some people are thinking, yeah, but I don't want to leverage. I don't want a mortgage. I want to be completely out of debt. Who knows if there's another COVID thing where people aren't paying rent or whatever. I understand there is risk involved. So you could put more money down. And again, every real estate transaction is going to be different, and you can come up with what makes you feel most comfortable. I'm just trying to point out the principle here. Okay. So again, 14,000 divided by 150, we get a 9.6 versus 30,000 divided by 5,760, we get a 19.2 cash on cash rate of return, which would allow us then to go and purchase more homes. So we could do this 5 separate times, earning 19%, right? So if we multiply 5 times 5 homes times 5,760, we've now made 28,800. We have thus doubled the cash flow with the exact same amount of investment. Now, for those of you that were asking about or thinking, wait a second, he was using gross numbers. Let's make this more realistic. Let's take it and turn it into a net cash on cash return. So I'm using some Truth in Lending software here. Okay, it's called a real estate analysis. And what we have here is, again, a mortgage payment of $719 or $720. We've got property taxes now. I've put in $100. We've got insurance of $50 a month, and those are monthly. So the property tax is about $100 a month. The insurance is $50 a month, and then maintenance, I've thrown that in. All of us that have owned rental properties know there's always going to be maintenance on those properties, so I've thrown in $50 a month there. So look what that does to our rate of return. It went from 19 down to about 11%. Okay, everything else is still equal, like it was. So you still have $150,000 for the mortgage, etc. Okay. One thing I have not put into this analysis is the appreciation of the property. Those of us that have bought property in the past want to know that the property is going to go up. And unless you get a 2008 or whatever, or maybe what's going to happen right now with COVID, who knows? Property should be appreciating. So if I move that to 3, the appreciation rate up to 3, notice what it does. It takes our rate of return up to 20%. But I'm going to take that out of here just to stay consistent and keep it easy. All right. So back to where we were at with a mortgage of $720, property taxes at $100, insurance at $50, and maintenance at about $50 a month. This means now that instead of having the $480 cash flow every month, now we only get to claim $281 of it. So it's gone down, but it's more realistic. So how on earth are you going to 3x this real estate returns with less risk? Let me get to that. $150,000. The real question is not whether you're going to invest all of that in cash in a property or leverage it. The question is, where was that money not sitting before you invested in real estate? You're going to buy real estate. It's got to be liquid, right? So did you put it in the stock market? Probably not. Too volatile, too risky. Was your money sitting in a 401k or an IRA? No, probably not, due to withdrawal penalties, right? By age, etc. So you probably didn't have it there either. Did you have it in a CD? Well, maybe in the beginning, but toward the end, probably not. Why? Due to the contractual time constraints. 2, 5, 10 years at a time, you have to lock up your money. And if you're finally getting to that point where you've got that amount of nest egg that you wanted, the $150,000, and you're ready to go out and invest in something, you need that money quickly. You need it liquid. So where is it probably sitting? In a regular old bank account, making 0%, but it's liquid, right? And that is what I want to show where we can improve on that warehouse of where we put our money. What I'm talking about is a place where you can get 4 to 5% guaranteed. Yes, I said that word, guaranteed, contractually, tax-free, compounded growth. Where do you get it? You get it in a high cash value insurance policy. I know. It has to be the proper kind of insurance policy. So this isn't your whole life insurance policy that is peddled by 99% of the insurance agents out there. In fact, most agents have never even heard of this. That's why I said what I'm going to show you tonight isn't something that most people understand. In fact, I was just looking for the book, but I don't think it's here in this office with me. But Tony Robbins' book on wealth, he points out that he got taught this, right? And when he was taught this, the person that was teaching to him, this isn't your normal whole life insurance policy. This is something that most people don't understand. It is a properly structured, high cash value insurance policy. I've done other videos for Diane that explain what those are. But just take it at face value right now that there are different kinds of whole life insurance policies, and these are high cash value insurance policies. So the majority of the money that you're putting in on a monthly basis is not going to buy you insurance or death benefits or etc. It's going toward cash value that you have access to just days after you put it into the policy. Okay, very different kind of policy. You get guaranteed growth. It's liquid. It's safe. It's protected from bankruptcy and other things like that, and it's tax-free. Back to the safe and protected. That is in most states. So the state I live in, it is that way. Check in the state you're in. I guess I got to give all those disclosures, but in most states, it's protected because the death benefit doesn't belong to you. So if you filed bankruptcy, the reason the courts have said that that money can't be touched is really it's a death benefit for somebody that's one of your heirs. And so if you file for bankruptcy, that money is still protected. That's what I meant by protected, and it's tax-free. Okay, so you now have that control. You don't have to wait until you're 50 something or 60 something or whatever to start moving those monies out. All right, so back to this calculator that I've got here. Same thing, I'm going to do it again, but this time what I'm putting in there is that we paid the closing costs of $4,000. Paid cash for the property, but we also had to pay the closing costs, right? And we're going to call those $4,000. So now our down payment is $34,000, not the reason it's going to be a down payment of, we had the $30,000 as the down payment, right? So now we're adding another $4,000 to it to make it more realistic. Note that the rate of return is 7.71. Here's what we're going to do though. that high cash value insurance product. And I'm going to go more in depth in this in a minute, but just accept for the moment that we borrowed $30,000 from our cash value insurance policy. And you'll see down here that we've taken out $30,000 as the down payment from our cash value insurance policy, right? So the only cash on cash that we've taken out is the $4,000 for the down payment. Now look what happens to our rate of return, 26%. All right, so I'm going to go more in depth on how the mathematics of that works, but just for now, understand you can get your rate of return from 7, which is where it was at, up to about 26. There's your 3x by just using cash value insurance for that 20% down payment, or 30 or 40, whatever you want to use to make you feel comfortable that you can continue to maintain those payments even if a renter wasn't in there in hard times. Okay. All right, so the key to high cash on cash rate of return is leverage. Leveraging not only the bank's money, but your own money in a high cash value insurance policy. In other words, you're leveraging from 2 separate areas. Okay, so you're not doing it just once, you're doing it multiple times. All right, quick overview. Cash flow, right? You don't own an asset unless you have cash flow in your pocket. If cash isn't coming into your pocket, it is not an asset. That's, again, where Diane and I fell down. We lost everything in 2008. Why? Because we were underwater on all of our properties. We were depending upon my income plus the rental income to keep all of our properties afloat. And when I got laid off, because I was in high tech for about 9 months due to the dot-coms, we lost a lot of our property at that point. In 2008, we lost the rest of it. So if it isn't cash flowing positive, be careful. It is not an asset. It is a liability. Second, net operating income, the definition, the annual income minus expenses. So we went through that. First I gave you gross, now we're talking about net. So $14,000 in rents is the gross rents. Then you had taxes of $1,200. Then you have insurance of about $600 a year, and then maintenance of another $600. So the net income in this example is $12,000. Cap rate, you'll hear the investors throw this around all the time. The capitalization rate, right? That is the ratio of net operating income to property value. And so let's say that you've got a property that's a fourplex or something, right? And it's worth $1 million, and it nets $80,000 in income a year, or a roller rink, or a storage unit, or whatever. That's where you'll hear this term a lot. And so if it's bringing in $80,000, you divide that by the value of the property, so $1 million in this case, and that gives you your 8% cap rate. Net cash on cash return. You divide the net operating income divided by the out-of-pocket investment. Again, what I just showed you, you use both the bank's money as well as your cash value insurance policy to leverage even more, and you put very little of your own cash down. Okay, so in this case, again, we had $5,760 net income, dividing that by $30,000 in the down payment. That gives us a 19.2 cash on cash return. All right, now we're ready for part 2, and this is where we're going to get more in depth on the life insurance. So if all of that was new to you or it wasn't, I'm guessing this next part is where we're going to take off for the seasoned investors and get a little bit deeper, okay? So cash purchases versus leverage or other people's money. I want to ask a question. Can your dollars do more than one thing at the same time? I remember when I explained this concept to my sister, and she's bought a ton of property. She's a property manager. She understands real estate. And I asked her, can your dollars do more than one thing at a time? And as I explained through this, it was like, oh my gosh, this light bulb went off. This was the thing that I did not understand when I started investing 35 years ago. And I know it's a real cliche. If I only knew now what, if I knew then what I know now, I'd be fine. I know that's a cliche, but it is so, so true. So again, can your dollars do more than one thing at the same time? Let me show you how. Here's how we acquire things. And I don't care if they're assets or liabilities. This is how we normally purchase things. We save a little more, and then we pay cash. And it looks something like this, right? We save over time, and then we pay cash. And then it doesn't matter how long we save or how much we save each time, this process is the same. We save, we pay cash, and where do we go? To zero. Back down to zero. Our money is gone. The opportunity cost to use that money is gone. Now, the American way, we borrow, right? And then little by little we pay it back. And we borrow again, and little by little we pay it back. In both scenarios, both ways, when we are through, we go back to zero. And that is what I want to teach tonight on how to avoid. Because there is another way of purchasing both assets and liabilities, and that is through, again, a high cash value insurance policy, right? It's uninterrupted compound growth, because that's what it provides. And I already went through what it does. So let me explain some of the the real numbers behind it. Now, there are terms that we'll hear: positive spread or velocity of money. That's sometimes what you'll see. So let's go back to this. 250K. Let's say that somebody has $250,000 in their cash value insurance. I run into people every single day now in what I do normally, which is insurance for property and casualty, who their parents have passed away. They've just inherited a home. There's 2 or 3 siblings, and so none of them want to live in it, so they split it up and they sell it, and each of them ends up with a chunk of cash, right? So now they've got $250,000 of cash. They could put that kind of money into a high cash value insurance and do this. Or some of them just saved all their lives, right? I said that to another gentleman on the phone just the other day. It's like, hey, congratulations, your home's paid off. He said, hey, it's 30 years of hard work, but it's done. So what we're going to do here is you've got 250 sitting there in cash, and you're going to borrow 200,000 from the cash value in the policy. And I worded that improperly. When you borrow money from your cash value insurance, you're really borrowing money from the insurance company, not your cash value in your policy. You're not borrowing your own money back from your policy. You're borrowing it from the institution, from the insurance company itself. What ends up happening is your cash value acts as collateral or a lien against the loan that they're going to give you. And since the death benefit is always going to be greater than that which you can borrow, they're not worried about it because they've already calculated out your death. And if you die, they wipe out the debt that you have and they give your heirs the rest of the death benefit, okay? So this is a zero risk loan to the insurance company. But again, the point I want to make clear here is that when you borrow money from an insurance company, from a cash value policy that you have, you're not borrowing the money from your policy. You're borrowing that money from the insurance company, and they're using your policy as collateral against that loan. So let's see what happens when somebody borrows. Say they've got cash value of 250 and they borrow 200,000. I don't care what you borrow that money for. Again, as I said a minute ago, you can buy it for an asset, you can borrow it for a liability. Doesn't matter. But in year one, let's assume that this person is going to, we'll continue with the real estate thing, but the insurance company doesn't care where you spend that money. Okay? So year one, 250,000 is your cash value, and that cash value is going to continue to grow contractually, guaranteed, no ups or downs. The dividends might move, but those aren't guaranteed. But you're going to get a guaranteed rate. Let's say I'm calling it 4% here. Depending on the companies you're with, and Diane only works with companies that have been around for 100 to 150 years. They've paid out dividends every single stinking year for that entire time, including the depression, including all the recessions, et cetera, et cetera, et cetera. These are very strong, capable companies. And they will give you a guarantee of somewhere between 4 and 5%, depending on the companies that I've seen her playing with. That's what they get. But I'm using 4 because that's kind of at the bottom end of it to be conservative. So your $250,000 in cash value will continue to grow, guaranteed, tax-free, at about 4%, 4 to 5%. Okay, so 4% times 250,000, you're going to make $10,000 on your cash flow. Now, what's going to happen when they loan you money? Are they going to loan you money at less? No, they're going to loan it to you at more. So the insurance company is going to loan you that money, let's say at 5%. Now again, they vary a little bit, but this is close enough to being accurate that you'll get the idea. So you borrow $200,000 to go buy a piece of property from the insurance company using your policy as leverage, and you're going to pay 5% to the insurance company in year one for the right to get $200,000. Well, what happens when you look at those two? They balance themselves out, right? You're getting paid $10,000 in interest on your cash value, and you just borrowed $200,000 and you're paying 5% on it, and they're charging you $10,000. Net effect, 0. Let that sink in, and let me ask you a question. Where on earth can you borrow $200,000 today at 0 interest? Nowhere, right? But that's year one. Now, again, let's go to year two. What's happened? Well, the 250 has grown to 260,000. And 260,000 times 4% means this year you're going to get paid $10,400 in interest, right? And you've paid down, let's say you've paid $10,000 down on this $200,000 loan. You don't have to pay back insurance policy loans because your death benefit will always cover it, but you want to be a good broker with yourself, a good banker with yourself. And so when you borrow money, the thing that everyone in this industry would advise is to go and try to make the same payments that you would normally be making if you had borrowed that money from a bank. So let's say you've paid $10,000 back. Well, now you're only paying interest on $190,000 at 5%, so you're paying $9,500. You with me? A net cost of a positive $900. Your loan and your cash value, when those two combine each other at the end of the year, you just put another $900 in your pocket instead of when you borrow from a bank. You with me? Year three, same thing. Now we've got 270, again, and a little bit of change times 4%. So now we make $10,816 in interest, and now we're only paying 5% against 179.5K, and we pay $8,975 to the insurance company, but we still net a positive $1,841. Are you seeing how powerful this positive spread or this velocity of money is? Because we're using our money twice in this scenario. We're using it once for our cash flow and then once as a lien to get a loan so that we can knock that out, right? Remember, when that $250,000 will continue to grow, if we look at how we spend money, again, whether it is the save a little bit, buy a product, and go back to zero, or borrow, pay it off over time, and get back to zero. In both of those scenarios, we had to go back to zero. But in the scenario I just gave you with a insurance policy, you never have to go back to zero. Your cash flow will continue to earn interest, compound interest, guaranteed by contract, tax-free, until you die. It's just that simple and that powerful. All right, so what are some of the benefits of high cash value insurance? That positive spread, right? If you could borrow for less than you're getting paid for your interest, you have a positive spread. But here's some of the benefits. Guaranteed compound growth. As I said, it's contractual. The interest rate that you are guaranteed is contractually guaranteed, and it does not vary. Now, the dividend varies, but again, as I said, the companies that my wife is working with have paid out for 100 to 150 years, every single year without fail. So you'll get the dividend also, it just isn't guaranteed. You can borrow your money and put it to work whenever you want. And they don't care. As I said, you can borrow it for an asset, like an investment property, or you can borrow it to buy a car. It does not matter. So you can borrow that money and it still works for you when you've done that. Whether you're buying an asset or a liability, it doesn't matter. The cash value is still back there growing. Leverage your cash multiple times. You can do this over and over again, right? Borrow it, buy something, pay it back, borrow it again, pay it back. You can just keep going on that wheel. You basically become your own bank. It is the banking concept that Nelson Nash came up with that allows us to bank on ourselves. Tax-free growth of the money. Also, tax-free use of the money. Difference there. One's tax-free growth, right? But also is tax-free use, because when you borrow that money, you don't have to pay taxes on that $200,000 that you just put in your bank account, right? You didn't have to pay tax on it. So you have access to $200,000 that you can take out of one place, put it into your bank account and use however you want, and you're not paying tax on it. So it's both tax-free growth as well as tax-free use. You get to use your cash value as collateral, and again, if something crazy happens and you do pass away, you have always more death benefit than you have borrowed, and the insurance company pays off your debt to them first, and then they pay out your heirs with what's left. So, all right, high cash value insurance is an asset, right? An asset under Robert Kiyosaki's definition. It puts money in your pocket and it never stops growing. That's why the ultra rich all have high cash value insurance. Okay. So again, back to Robert Kiyosaki, an investment is something that puts money in your pocket. It puts cash flow into your pocket, and that's what a high cash value policy is. All right, so I've put together a policy here, and I decided to do it on a guy by the name of Hugh Jackman. Heard of him? Movie star? Anyhow, 15 years younger though, so made him 34 at this point, so I could take it out a little bit further. You with me? So Hugh Jackman is going to put in $2,000 a month toward his high cash value policy. Now, I have done some other videos for Diane that explain how all that works and the mechanics of it, but just follow along with this. If you want more, get a hold of her, and she can explain the details of how these policies work. I want to give you the concept here, okay? So he's going to put in $2,000 a month or $24,000 a year, okay? And here where it says total net cash value, that is the amount of money that he can borrow against at any time he wants. So at year 8, you're seeing that he has the $200,000 available to him. So let's walk through that. $200,000 purchase price of real estate. Now let's say that this piece of real estate, he's going to sell it in 20 years. Okay, so this is a 20-year deal, which is twice as long as most people keep property. $2,000 a month in rent, and we go out and we look at, again, a future value calculator of what that $200,000 is going to be in 20 years at a 3% annual interest rate. So what I've put in there is this time I am saying, okay, the home is going to appreciate over 20 years, and it's going to appreciate at 3%, so that gets us our $361,000. All right. Now those numbers are the same whether he pays cash for the property or he uses other people's money for leverage. So let's walk through the cash purchase first. The cash flow for 20 years at $2,000 a month for 12 months for 20 years means that he has just made $480,000 over that 20-year period. Okay, this is where we're going to compare the two different types of methods of buying real estate. Okay, the market value of the home, as we just determined, at 3% more every year, would take it to $361,000 instead of the $200,000 original. Right now, we have to subtract out the $200,000 for the purchase price of the property, and we end up with $641,000 over that 20-year period. Now, let's compare what happens when we go to use other people's money, and in this case, our cash value loan against our insurance policy. Okay, so once again, I'm going to jump in here to a loan analysis software package, and I've put in all the same numbers. So the loan is $200,000, the APR is 5%, and the term is 20 years, right? And the monthly payment then is going to end up being $1,319.91. So I just rounded up to $1,320. You with me? So that's what the payment is. Again, as I said a minute ago, you do not have to pay back insurance policy loans ever. These are unstructured loans. Structured loan is what you get at the bank. It's structured because on the 1st of every month you owe the mortgage payment, right? Or on the 16th of every month you owe your car payment. And that's just, it's structured. Every 30 days you have to pay it. With an insurance policy, again, since the death benefit will always cover it and they've got the calculation on what the probability of your death is already, they don't worry about it. So you can pay it back if you want, or you can skip. Let me take a second here to pause. When I lost my job, and went 9 months, my wife had just had a baby, she wasn't working, well, she was working, but not out in the marketplace taking care of our children. I didn't have a job, we did not have income, and we had all those properties that were underwater. Think about that. If I had borrowed money from one of these policies to purchase my homes, guess what? I could have done one of two things. I could have either borrowed the difference between the rental payment and, let's say our payment was this big and we were getting this much in rent and I had to come up with this much, but I didn't even have that much because I didn't have a job. But if I could have just borrowed that much for each of those 16 properties, which came out to a pretty hefty amount on a monthly basis, if I had been able to just borrow that much every single month and borrow enough to live on during the 9 months that I was out of a job, I wouldn't have lost my real estate. I could have kept it alive. Or if I just used the money like I am using in this example, where I took the whole $200,000 out, right, and bought the property with that $200,000, I wouldn't have to pay a single payment against myself ever during that 9-month period where I was out of work. That's why I said this is the school of hard knocks that I didn't learn, and I lost 16. Diane and I lost 16 rental income properties due to not having cash flow. So again, cash flow is king, and that's why I really admire what Robert Kiyosaki taught me. But back to this scenario here. We've got a $200,000 loan, 5%, 20 years. The payment on that, if it were structured, and it is not, but if it were structured, would be $1,320. And that's what you want to do. You want to pay the $1,320 a month. I mean, think about it. Diane and I had paid in, depending on which one of those mortgages we were talking about, anywhere between 10 and 15 years. And I could not go back to any one of those lenders and say, oh, you know what? I've been paying extra. Oh, that was another mistake we made. Instead of putting money aside, at the end of each month, when we had extra cash available, we just paid it down on our mortgages. So we've been paying down on these mortgages. Not only do we have them on 15-year notes, we've been paying down on them faster than we could. I could not call up any of those lenders and say, oh, by the way, I've already paid you, a year's worth of payments extra. Just cut me some slack till I get a new job. Nope, couldn't do it. And I lost everything. And that's why I'm saying if I had had something like this that I'm showing you right there, if I had had $200,000 in a cash value account, I could have taken out, again, that difference between what I owed and what I was getting in rents and kept all of those properties afloat. And I'd still have millions in real estate today, but I don't. Anyhow, off topic, apologize. All right, so this is how much he ends up with. So now we have cash flow over 20 years, right? But it's a lot less. It's not the $2,000, right, that you get if you pay cash for the home. Now you're getting $2,000 a month in rent, because that doesn't change. But you've got to pay the mortgage, which is $1,320. Again, if that's a loan to yourself and you fall on hard times like I did, you don't have to make a payment that month or the next month or the next month, right? You just catch up whenever you're back up on your feet. But you want to pay back these loans so you have that money available to act as your own bank later on. I think I've already beaten that dead horse. But $2,000 in rent, $1,320 in a non-structured payment that you're going to pay as though it were structured, leaves you $680. Okay, so $680 in cash flow times 12 months times 20 years comes to $163,200. Now I know there's a lot of you going, wait a minute here. If I pay cash for this thing, I get $480,000 over 20 years in cash flow, and if I borrow that money, I'm only getting $163,000. And I think most people's minds would shut off right there. This doesn't make sense. But we cannot forget the power of the compound interest that our cash value insurance is still making. Okay, so the positive spread. Now remember, this Hugh Jackman, in my example here, Hugh saved his money, right, until he had $200,000 that he could borrow. Now, if this was just cash, not sitting in a cash value insurance policy, this was just sitting in his bank, as soon as he threw that $200,000 down, what happened? Boom! That $200,000 is gone. The opportunity cost to use that $200,000 is gone. He went to zero. He paid cash, means the opportunity cost is now gone. He cannot use that money anywhere else. He went to zero, right? But if he had used it in a cash value life insurance policy, that cash value is continuing to grow exponential, not exponential, but compound interest curve all the way up. So again, year one, 250,000 gets 10,000. Year two, when he's got 260, he makes 10,400. Year three, when he's got 270 in the cash value, he makes 1,816. He's making $10,000 a year plus every single year for having his cash value still there, even though he has a loan out at 200,000. That is the huge difference of using high cash value insurance. Okay, so when we multiply 200,000, because that was the amount we borrowed, at 4%, and that's what the insurance company is giving you guaranteed. Now, that 4% is super conservative number. Okay, that's the amount you get guaranteed. As I said, and I've said it already, and I'll say it again, the companies that Diane works with, the companies that are the best at this are mutual companies, and they've been around 100 to 150 years. Okay, let her talk to you about the ones that she represents, but those companies have paid out dividends without fail for over 100 years. Okay, so the odds that it's only going to be 4% is very minimal, because you're going to get a dividend. Plus, you get the value of tax-free growth. Remember, if you've got stocks out there and your stock makes $20,000 in this year, you're going to get a 1099 and you're going to pay tax on that $20,000 you made. That does not happen with an insurance policy. Okay, so to say that this is only 4% is unrealistic, but it is very conservative, and I would rather be super conservative in this type of an environment than to be overly optimistic. Okay, but let's say that that value is going to be somewhere between 4 and 8%. It's not going to be 4, but for sake of the example, we'll keep it at 4. Okay, so what did I do? I went out to a future calculator, and I said, okay, I've got 20 years, 200,000 at 4%. That is the guaranteed amount. That means that I'm going to have $438,000 instead of 200,000 at the end of those 20 years. Okay, and as I just said, I put the asterisk in there. This does not include dividends, and it does not take into account the value of having tax-free growth and tax-free usage. Okay, so you try to use your money in your IRA, you know what's going to happen. You're going to get taxed immediately at a higher rate, and they're going to give you a penalty. So none of that happens in these scenarios. So that 4% is a super conservative number. But be that as it may, so we have 163,000, as we pointed out, in cash flow, right? And we've got the 200,000 at 4%, which comes to 438,000. And we still have the exact same market value of the home 20 years from now, which is 361. So when we subtract out the 200,000 for the purchase price and add all that up, we now get $762,000 for the investment that we leveraged using a high cash value insurance policy versus the 641,000. There you go. Is that powerful? I mean, that's what, another $121,000 in 20 years, or 19% ROI extra that you wouldn't have had otherwise. That's what the power of an insurance policy is. Now, I also want to talk about some of the other benefits. I know this is about real estate, but we're using a life insurance policy as the vehicle to warehouse our money, and I don't want to pass over some of the benefits that come from having a life insurance policy, because it still is a life insurance policy. So that total net cash value column that you see there, at 8 years, he had 200,000. But look what he's got at 15 years. 460,000 he can borrow. What could you invest in at age 49 if you had 460,000 available to you? Or at age 54 when you have 705,000 available to you? Again, this is just putting in $2,000 a month. And then, again, if Hugh Jackman, my fictitious human being that I'm using this policy on, were to pass away during any of that time, he still has $1.6 million available to him to pay off all those debts, right? So if he had that $200,000 loan and there was still 150 of it outstanding, his family is going to get the death benefit less 150,000, so they're still going to get $1.4 million. You know, it's still there. It's still a life insurance policy. Okay. Now I want to talk about another thing about life insurance policies real quickly. This net cash value can continue to grow, and it will for as long as he keeps the policy alive. And you're thinking, oh yeah, well, I've heard that the problem with whole life policies is you have to pay on them forever and ever and ever. That isn't true. They will fund themselves after they get so far into it. So look at here what I've done. At year 21, he quits paying $2,000 a month. So at age 55, he drops that payment down to $6,000 a year instead of $24,000 a year, right? A lot less. But here's one of the things I want to point out. Note, between year 21 and 22 on this policy, he only put in $6,000, but look how much he made. It went from $744,000 to $784,000. Tell me, where does a 55-year-old get to put $6,000 into an investment and at the end of the year have $40,000 extra on that $6,000 investment? Tax-free. Bam. There are so many other benefits to whole life insurance other than just the topic at hand today, which is real estate. Well, in fact, I know I've used real estate as the example, but like I said, the insurance company doesn't care what you invest in, right? If you've got a good friend that calls you up and says, hey, I've got this company, we're doing this is our sales, we've got this disruptive technology, invest now and it could, 5,000x. Great. Pull a little money out, toss it to your friend if you trust them. You know what I'm saying? You've got that ability. It doesn't matter. It doesn't have to be real estate. It can be a car. It can be a vacation. It could just be money to live on when you get to an older age. You can just borrow it down. Okay? So I hope you like that. Hope you saw the power of having other people's money work for you by borrowing from the insurance company and letting your cash value policy act as the collateral for that loan.